Economic downturns, inflation spikes, a world filled with uncertainty. These moments leave many investors uneasy, questioning whether they should stay in the market, shift to safer assets, or just pull out entirely. But history tells us one thing: turbulent times have always existed, yet smart investors not only survive them, they thrive. The key is understanding how to strategically invest during uncertainty rather than letting fear dictate financial decisions. Fear is one of the most influential factors in market behavior. As headlines scream recession, interest rate hikes, and instability, panic spreads like wildfire. Investors sell, the market tumbles, and we see what economists call a self fulfilling prophecy. A downturn worsened because of reactionary decisions. But let's pause for a moment. Historically, every market downturn has led to a recovery. Some of the world's greatest financial minds, Warren Buffett, Charlie Munger, and Peter Lynch, agree on one core principle. Successful investing is about long-term thinking, not short-term panic. Instead of exiting the market, smart investors understand that moments of crisis often create buying opportunities. When prices are low, assets once considered expensive suddenly become accessible. The question is, what should you invest in when uncertainty dominates? During uncertain times, the concept of diversification becomes more critical than ever. A portfolio composed of stocks, bonds, commodities, and stable assets ensures that if one area takes a hit, others may remain secure. Here are four key investment strategies to consider during turbulent periods. Companies in healthcare, consumer staples, and utilities tend to retain stability even when the economy declines. People will always need medicines, groceries, and electricity, making these sectors more resilient. Gold, silver, and other precious metals historically act as inflation hedges. When fiat currency weakens, these assets tend to rise in value, making them a solid option during volatile market conditions. Instead of handpicking individual stocks, index funds provide built-in diversification. Investing in broad market ETFs like the S&P 500, for example, means riding out the market corrections with less exposure to extreme fluctuations. Rather than trying to time the market, successful investors consistently invest over time, a strategy known as a dollar cost averaging. This method reduces risk and eliminates emotional decision making by focusing on long term gains rather than short term market shifts. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This means that when panic selling takes over, investors willing to think long term often acquire valuable assets at a discount. The 2008 financial crisis, for example, left markets in ruins. Yet in the years that followed, those who invested during the lows saw exponential returns. Similarly, the COVID-19 crash in 2020 sparked intense volatility. But within months, markets rebounded stronger than ever before. The takeaway? Crashes and downturns eventually recover. History proves that strategic investing during uncertain periods often results in long-term financial success. The key to investing in difficult times isn't avoidance, it's adaptation. By understanding the psychology of the market, utilizing defensive strategies, and staying committed to long-term growth, investors can turn uncertainty into opportunity.
Is an opportunity.
So here's the question: are you reacting to fear or are you preparing for financial success? Let me know your thoughts in the comments down below. What is your biggest investment concern right now? And if this deep dive helped, consider subscribing for more insights.